And we are officially live. Another episode of Shut Up and Invest. We got my man in the house, Jay Money, as always. And we got a special guest in the house. Make sure you guys stick to the end because the hacks we're going to get into about apartment building and a couple of other things. Mr. Donahue Baker himself. How you doing, boss?
Doing well, doing well. Pleasure to be here with you guys.
All the way from Jersey, right?
Yeah, absolutely. Absolutely.
What part of Jersey? What part of Jersey?
Well, I'm in Central Jersey, Scotch Plains.
Got you. Okay.
Yeah, you know about Jersey?
I mean, I'm from Pennsylvania. I'm from Pittsburgh, Harrisburg, Philly area. So I went to Penn State with Jersey people like crazy. So I know Jersey.
I hear you.
You know where all the sorry football teams are. You guys are from that area right over there.
No,
right?
hey, Steelers. I'm a Steeler fan. I think my team won. I don't know if any New York teams won. I know the Dolphins lost. So
you celebrate Big Ben coming back for a little while.
That's why I got on black and yellow today. Steelers,
black and gold, baby. I see the black and gold.
Yeah.
Now, Mr. Baker, let's get down to the nitty gritty because our people are definitely interested. It's one of those big topics. Everybody is dying to see how to get in the apartment building game. Now, I know you're in a lot of aspects when it comes to real estate investing, not just that. So why don't you give us a little bit of background? How'd you break in? And then we can kind of go down the yellow brick road on the apartment building side of things.
Absolutely. So I started really small apartment buildings, right? 2-family was my first purchase. It was a duplex, lived in one side, rented out the other. And literally every single year just scaled, increased the size of my portfolio every single year. Eddie, what's going on? So that really was how I built my portfolio today. I'm actually a co-founder for a startup. It's called Money Avenue, and we're a fintech bank. And what we do is we help people we focus on wealth management, but we help people to scale their portfolios as well. And that's our focus, building, increasing wealth. We're a bank. We can give you funds. We can show you how to do it. We can put you on a unique strategy to help you accomplish all your goals.
Gotcha.
Nice. At what market did you start in?
Started right in Jersey, North Jersey, New York. We started in there. Now we service the whole nation. We can help people from all over. So that's really where we are right now.
Yeah. I think one thing too. So before you got into real estate and doing apartments, I mean, what were you doing before? You were a CPA, correct? I think.
Yes, I did have a CPA practice. Even before that, I was a music producer. So,
okay.
Yeah, I started in the music game. Grammy nominated music producer.
Hey,
yeah. You know how that music industry is. It's up and down, but luckily all through that whole process, I always jumped in to real estate. Molin, what's good, brother? It's my peoples,
Oh, we got a tight family over here, man. These are all good people that come by. So you were doing some music producing. You went from that to CPA, and then you kind of went into real estate. And the key thing that you mentioned too, me and Kevin talk about this a lot. We actually do a show about this soon. Is you basically house hacked, right? Your first deal?
Yeah, absolutely. It wasn't called house hacking back then,
no,
but we jumped in, and I just saw opportunity to where I can live in one side and just live rent free, and that's really what set me on the trajectory to really scale. Because if you can get to that stage where you can live rent free, you're living better than 70% of all Americans. Most people can't even do that. So if you could do that, eliminate your number one expense, it's a tremendous lifestyle to have.
I agree, definitely.
Now, when you were doing the CPA game and in the music game, was it ever in the back of your head that you wanted to essentially transition and start investing into real estate, or did it just land on your lap? Tell us a little bit about that first deal and how to transition.
Yeah, my very first deal, I basically, when people in the music industry, people would get these checks, these 6-figure checks, and they would buy jewelry, they would buy cars. And I saw the trajectory. I saw how it ended up for them. And I was like, I don't want to be that person. I just want to use my first check. And we got a nice 6-figure check to purchase an asset that's going to pay me. And that's what led me to real estate. So it was in the back of my mind all along, just because I always saw how other people did it and how wealth was built. So it was very, very key.
And so real quick too, because I mean, a lot of us don't see that coming up. I know you're from Jersey. I know a little bit about your backstory, right? So like, you went to school in Georgetown, correct?
Yeah, I did. I graduated from Georgetown University.
So did you pick up kind of that financial intelligence when you were in college? Like, when did that come to you? Like, hey, this is the right thing to do, instead of going to buy the chain or the Benz or what we buy a lot with our first big checks.
I think your environment affects you. So it's not like I sat in a class and it told me this is what you need to do. But going to Georgetown, you're amongst bright people. It comes where your environment affects you. There's no secret. There's lots of money there. We went at Georgetown at a time where people from the hood as well as people from really wealthy families. My roommate was actually of the Anheuser-Busch family, so I know specifically what
long money
wealth. And I grew up in affordable housing projects, so I had to basically scale that. But absolutely true, your environment determines how your aptitude, how far you go in life. So they said that if you hang around with 5 broke friends, you're going to be the 6th. I firmly believe that. And a lot of times today, I was asked to be a professor teaching entrepreneurship, teaching wealth building at Morehouse College in Atlanta. And these students of today, if I would have had the opportunity that they would have had, I just marvel at what I could have done. So the opportunity is out there to create wealth. Technology levels the playing field, and we have to show our children and young adults how to really exploit that, because they have a tremendous opportunity.
Yeah, I got a question. As far as right now in your current business, how important was some of the networking and contacts back in, like, let's say Georgetown and in the music industry? Are those contacts and those relationships right now still part of what you do today?
Absolutely, 100%, man. I tell you that going to Georgetown, and I'm sure this is true for a lot, and I tell this to students that they say college is a scam, right? Because they say college is a scam because technology, you can find anything you want on the internet. Like, if you want to learn how to do something, you can. If you research hard enough, you can find. But what you can't find is that college experience. So I tell people that if you feel college is a scam, still try to, as a young adult, try to take advantage of the college life, because you don't need to be enrolled to sit down in classes or to meet or network with other college people. So, and I think there's value in that. So the story that I would give is, I had a really good friend when I was at Georgetown that didn't go to Georgetown, but he used to stay with me all the time. Right? Yeah. But he wasn't a student. He just he just hung out. Yeah, he just hung out.
He was a guy on the couch.
Yeah. It was that guy that would come in and just be on the couch. But all the relationships that I had at Georgetown, a lot of people, still to this day, he has that network, but he didn't go to Georgetown. So the same. And then I was with the mayor of Newark, New Jersey, Raz Baraka, and Raz said this, and it struck a curve. But he said that, and it was a men's meeting, and he said, if anybody out here wants to learn, just go to Rutgers or Seton Hall and sit down in the class. And I dare the class to come to me and complain about it, So it was like, a lot of you don't need a grade. You just need that experience. And that's really what's important. And we need to tell our young kids, do not be denied. Don't let financial means inhibit you in any way. You just got to go and keep pushing forward.
That's huge what you said. Like, don't let the fact that if I can't get enrolled there stop me from going to learn, right? Because and the thing is, college experience is amazing, right? Experience and networking. I know I have people now to this day who I met in college who I still network with, right? The cost of it can be a little bit exuberant nowadays, right? So that's the whole scam part people get. But the actual networking, marketing experience of doing that and being on your own and learning how to figure it out, you can't, it's priceless. So I definitely get that. And Ross Brock, that's a good guy, man. I like him a lot too.
Yeah. Hold the line. That's the dude right there. Yeah.
All right. So then you went through your college experience. You're building a nice network. You started doing house hacking, and essentially rent started paying for your living expenses. You got addicted to that feeling, I imagine, and that way of life. How do we transition from there? Which is, we have a lot of people watching this show that they are doing their first deals and they have made some residential investments. Everyone aspires to start moving up into multiple units, these apartment buildings and anything that's 5 units and up. But it's also daunting or scary, or they feel they need a lot of money to be able to do this. So walk us through your first venture into jumping up into a multiple unit situation, and then start dropping some knowledge on what you think people out there can start doing themselves.
Absolutely. So with me, it just started with that duplex, right? I set out to just double the number of units every single year, right? So, started with the two. I bought a 4 unit, and then I bought a 6 unit, and then I just tried to double, right? Some years I was successful, some years I wasn't. But the point is that, I wanted to make more money the current year than I did in the previous year. And I still have that goal, right? To really just purchase one apartment building every single year and that's my goal for as long as I'm doing real estate. I just want to do one deal a year, right? So from there, the mentality, once you get to around 6 or 7 mortgages on your personal credit, you have to realize that the banks say, no, we're not going to lend you anymore. Yeah. So you got to be creative at that point, right? Mm-hmm. And what I did at that particular point in time was figure out other means in which I can leverage not only my experience, but also my finances. And what that led me to is syndications. My first deal was my first big apartment deal was a syndication. Then I figured out business credit, which I use that to this day, and that's something that's grown with me over the years. Another strategy is just finding someone that you can partner with. So I have a partner right now that I no longer do syndications, but we have a fintech bank. So now the bank funds all the deals, and that's basically the strategy that I've used to scale my portfolio. I'm doing development deals right now. The bank is funding those deals. I have a line of credit. I actually have a business line of credit that is not connected to my personal credit profile. And believe me, a lot of those soft costs come from that line of credit. And the more I use it, the more I replenish, the higher the lines get. Right now, I'm at $3 million. So I have a $3 million line of credit. That is really the engine that fuels a lot of the deals. And I'm doing more development deals now as opposed to smaller multifamily buildings.
Wow. Okay.
Can we, Jay, before we move on, break down what a syndication looks like? What are the ins and outs and pros and cons of a syndication? How you kind of got started, and now why did you move away from that?
Sure. Well, the syndication model is strictly pooling funds from other people, right? The model that I used was the LP model, where I am the general partner up here. Then there's a series of limited partners below, and depending on the dollar amount, depending on the capital stack and the dollar amount that you contribute, that determines your ownership percentage, right? So just for the sake of math, for the people, let's say I'm trying to raise $100,000 and you put in 10,000, then you would own 10%, not only of the cash flow, but of the equity of the property in essence, right? In a very simplistic form.
Like when we rent an Airbnb, if I'm putting more money, I'm getting the master bedroom.
Exactly.
Yeah, that's
exactly. So that's how it works, right? The problem, and this is where it is. Sometimes, and as you get into apartment buildings, it's very important that you have the exit strategy. So sometimes it's easy to get into a deal, but then you have to get out, right? So the reason why I no longer do syndications is because some partners, when you go in, and the strategy that I use is every single apartment deal has always been like this. Every single apartment deal that we acquire, what we look for is an infinite return. Let me define what an infinite return, just in case any of the audience is not familiar with the infinite return, but the infinite return basically is all the cash that you put into the deal, you get that back, but you still retain your ownership, your equity position. So it pays you and you have no cash in the deal at all. And it's an infinite return because that you don't have any money in the deal, but you're actually getting cash out of it. That's what we shoot for. Sometimes we can get there in less than a year. Sometimes it may take us 3 or 4 years, right? Depends on the deal. But that's our goal, and that's what we shoot for. And it's when you have a lot of partners in the syndication, like I had 10 partners in my first syndication deal. When you have a lot of partners, everyone has different interests, right? Everyone's different ages. Some people have kids that are in college. They need to pull money out. So they want you to sell. And it's like, you had all this equity. Let's just sell and walk up. But, the strategy, and you have to have a strategy. My strategy has always been to buy and hold, right? So even though we forced appreciate and create a lot of equity, what I try to focus on is building that so that it's literally a passive stream of income. Some people have the mindset, let's just sell and pull out, and it creates a lot of chaos. Yeah. So that being said, that's why I no longer do syndications, because the interest, it gets it strains relationships, but at the same token, it's just an easier way to do things as well. You don't have to do a syndication, but a syndication is a valuable tool, especially in this day and age. It's just sometimes it's easier, but long term, it's better ways to do that. And I try to help people develop other strategies around syndication.
Awesome. While we stay there real quick, so you're looking to hold all your buildings, correct? So that's why because you're not looking to do the whole remodel, fix it up, build depreciation, and sell it off. You want to keep them and hold them, correct? So
I do want to increase the value of them, right? So
that's what I was getting to. So you're doing value add, right? You're buying. Well, right now you're developing, but you were doing value add. You take a building that might be getting rents below market value. You go in and you'll fix them up, bring the value up, and you're going to refinance to pull your money back out. Is that kind of your strategy?
Yes, we do that to create the infinite return. That's the idea, right? We get in, we look for value add opportunities, then we force appreciate, right? So we bought a 100-unit apartment complex out here in New Jersey. The thing is, we purchased it for $5 million, but we put a couple million in. That apartment building, $12 million of forced appreciation that we created. That's real wealth that was created, right? So that's a significant strategy that I think you won't find any other aspect of real estate but apartments. You definitely on the commercial end, sometimes you can see that, but apartments, the valuation is based on the income that it generates. It's not like the residential side where we're using comps and things like that. So you can leverage that. You can find a building that is hurting or has a defect that's struggling. It has a low valuation, but you have the insight to come in and say, you know what, I can cure that defect. I can fix this problem because I have X, Y, Z. I have, certain skills, or, I manage better because I have systems in place. I can come in, fix the defect, and you can create a lot of money in the process. And that's what I try to show and teach people, how they can do that, spot those opportunities, analyze them, and then fund them through my company, Money Ave.
Yeah, the management part too. I mean, a lot of you make off by a lot of bad management by other sellers, correct? So if you're a good manager, that's the way to add value immediately by being a good manager. Is there a way you can kind of maybe show us an example of forced depreciation? Because a lot of people probably don't know exactly what that means as a tax strategy.
Absolutely. So I'll just, since you mentioned it, I'll just tie it into property management, right? One of the things that we look for when we're searching for opportunities is we try to find managers that are not managing efficiently and effectively, right? Now, what does that mean? Well, the financials tell the full story of a property. So let's say, and I can paint broad strokes here, right? Because I analyze over 100 deals a month, apartment deals, right? So what happens is when you analyze that many deals a month, you start to see trends. You start to see numbers that correlate with other numbers. So I can basically, you can tell me, well, this apartment deal brings in 100,000 in revenue. Now, based on that fact alone, I should be able to disseminate that the expenses should be in the range of $50,000, right? Mm-hmm. Now, when I look at the financials and they say 30,000, right? That's low, the 30% operating expense ratio. I'm either thinking in the back of my mind, these guys are so good, or they're hiding something.
Yeah.
Or they're trying to get over on me or something, right? So then I look at that and I say, why are the expenses so low? Probably they're trying to make this building or business more profitable than it is. Red flag goes up. The converse is also true, right? If I know that the expenses are 80,000, then I'm thinking, what's going on? Why are they not operating this thing efficiently, right? So I'm thinking, all right, what could they be hiding? Could they be trying to show less income so they pay less taxes, which a lot of mom and pop owners do, right? But there's other ways to do that, right? Now, as a CPA, that's where the CPA hat comes on, right? It's really spotting those opportunities and then knowing how to use it against the seller to lower the price, right? So I don't retrend, I don't retrade, they call it, right? When you get it under contract, we don't try to renegotiate the price. We don't want to do that. That's bad business. But what we do is we want to pay a fair value for the particular asset. And the number that the seller is giving me, those, through the due diligence process, we verify that. And we use that to make sure that we're paying the right price for the asset.
Got it. Awesome.
I love it. Preach about that. So for those listeners, you identify a building. Then if you go the syndication model, which was how you got started in this niche, you get your friends, you get your family, you get your contacts, your network, you tap into the resources to try to pull together the down payment that is going to be needed to acquire this property. Then the rest, you get financing from commercial lending. Is that, or are you buying the whole thing cash from your experience?
Right. So our financing at this point in time it all comes through the company Money Ave, right? MoneyAv.com. We fund, and we actually have a 6-step plan to help people get to the level where they can start from the duplex level all the way up to creating $1 million a year in rental income. It's literally a 6-step plan, right? So that's the key. We don't.
But prior to that, because I want to get to that, I want to hear more to that. Yeah. Prior to that, if people are in your situation just starting, now they know they can contact you and get a hold of this. But the traditional model that they may hear out there is pulling together some resources, getting the down payment, and getting the syndication down, and either getting commercial lending. In your first couple of deals, was that syndication buying out these properties cash, or were you also getting lending to complete the rest?
Beautiful thing about real estate is I'm a firm believer in leverage, brother. Even you might say, well, $5 million is not a lot of money, but to raise $5 million is a lot. So what we purchased a building $5 million, really only have to raise $1 million, which not a lot. I mean, I'm sure, I guarantee you, 60% of the people that are listening to this podcast, all within your cell phone, if you had to raise $1 million just by going through your cell phone, if you have a good deal, I guarantee you can do the same exact thing. Mm-hmm. Same exact thing. Right. So it's not hard to raise $1 million, right?
And then the other $4 million came from the commercial lending institution?
Correct, right? So we used Capital One, right? So we used Capital One commercial division. That was how we did that deal. So it's not a complex deal, not a complex situation. Anybody can do it. I don't want to make it seem so easy, but when sometimes numbers scare people. So you say, "Oh, you got to go out and raise $1 million." It's the concept. But quite honestly, maybe you have one whale, right? Maybe you have one person that has an IRA of $500,000, right? You get them in, and then you find 4 other people that can put in 100,000, and that's the deal. You know,
Mhm.
that's pretty much your deal. You know, or you could do like me. You get really, really creative, right? And I'll show you what I did to get really, really creative. One thing that I did is set up some LLCs, right? Where instead of just going out and doing syndications, I set up LLCs, leverage the business credit of the LLCs, and then pull that out to come up with the down payment. When I went to the closing table, what we did was, you know, you put a deal like that, you pay yourself an acquisition fee, and I basically reimbursed the business credit. You know, something creative, you know, as opposed to giving away equity.
Mhm.
You know, so that's, you know, just so many different options.
I heard you mention business credit and talk about it before. Kind of give, you know, business credit to a lot of people that feel like that's so hard to acquire. Like, what are some steps on acquiring business credit for yourself? Like, what would be the steps to start to get to that point?
Okay, well, you know, business credit is it's a funny thing because it's thrown out there, and a lot of times people just say business credit, but you need to understand. Just take a step back. Business credit is a tool, right? And to understand business credit really fully, you have to understand the power of the LLC, right? The LLC, if you're not using your business credit in the confines of the LLC, you're not using your business credit correctly. Right. And what I mean by that is when you set up an LLC, it's a completely separate legal entity. A lot of companies out here are giving business credit and they're relying on your personal credit to qualify for the business credit. Right. That's called being personal guarantor, being a PG. That's really what that is. It's like if your personal credit score qualifies you to get a line of credit under your business credit, that's defeating the purpose. How you set up your business credit is you want to get an LLC that stands on its own, and then you want the credit of the LLC to be built up so it's not, you know, linked to your personal credit at all, right? That's the way you want to do it. And then you want to go out and you want to get millions of dollars under that LLC, millions of dollars of credit under that LLC. That's the way that we show you how to do it at Money Ave. We tell you to get your personal credit score to 720, you lock it, and then you live through your business. You live through your business, and your business does all the everything that you need in terms of qualifying for financing, getting lines of credit, getting you know, overdrafts, building out these ecosystems, figuring out what state that you need to incorporate on, because that's also a key thing in the process, right? There's so many different components, but in order to really put yourself in the position where you have an LLC that stands alone, you have to have these things in place.
Awesome.
I love it. Now, this $5 million deal, what were some of the value adds that you put together after you acquired it to be able to get it up to that $12 million evaluation? What are some of the things you identified, and then what action steps you took, and how long did it take?
Yeah, so roughly it took about a year, but for that particular project, what we did was we put on new roofs. We milled the parking lot, so we overdid that. Where we got a tremendous amount of increase in the valuation is just change in management. So you had a mom and pop operation that was running them, and they really was running this operation without a computer, right? So I mean, it's just, you know, back of the napkin stuff, but they've been for 30 years, and that's the way that, you know, that's the way they ran their business, right? So when we came in, it's putting systems in place. It's going out, going to the market and hiring the best property manager. How do you get the best property manager? You look for the brokers. You get word of mouth. You get references. You get the best property manager. They come in and they take over and they create these efficiencies and create the systems that really, you know, you have to have a process in place. You have to have a tenant profile in place, right? When you don't, and you just open your doors and rent to the first person that walks in, that's not adequate. That's not best practice. That doesn't work, right? So there's a number of different things, but having a great property manager solves so many problems.
Yeah. And the flip side, if the property manager is not the right pick, then it becomes a headache,
Yeah.
and it could go the other way.
Yeah, sometimes, look, I've had to fire property managers before. You have to kiss a lot of frogs sometimes when you're dealing with contractors. Unfortunately, property managers fall into that category too. But what I've learned is if you have a property manager that is referred by brokers and also by other owners, you are not going to lose. You like that. I can assure you that their reputation, like usually we go into a city, like we go to Jacksonville. Give me the best, like you can ask. And I believe in the Pareto's principle, where if you go to the brokers that are doing the most volume and just ask them, say, look, I'm in this market. This is my first property. I need a great property manager. Give me a list of 2 or 3. And if you start to hear the same names over and over and over and over as you go to different brokers, you have a good property manager.
There's a trend.
Yeah.
Definitely.
So a good property manager lowers your expenses, makes the run more efficient, increases customer satisfaction and retention. Then at that point, you start raising the rents as the leases are expiring.
Yes and no, right? So it depends on a property. You like, for me personally, I raise the rents if they're below market, right? If they're below market and there's room to raise the rents, absolutely, we raise the rent. However, property is at market level. I don't necessarily believe that's the best strategy, is raising the rents, because it's going to have an inverse effect on your vacancy rate, right? So I think as long as you have the right tenant profile and you're charging an adequate rent, I think that it's really about just making sure that you can provide the best experience for your tenants. At least that's my philosophy. I'm more of a long-term investor, because I want tenants to be there for as long as possible. My niche is affordable housing, right? So a lot of my tenants come from Section 8 background, so and I grew up in that, and I know firsthand, if these owners, they come in, they just want to raise the rent, and not everybody can afford it.
Definitely.
A lot of people get ejected, and they can't live up, so they get ejected. I would much rather have a property that I know I have some upside if I need to, but because I'm happy with my tenant base, because my tenants are taking care of my place, I'm comfortable with charging them $50 less or something like that. Yeah, so it's a long-term strategy.
Definitely.
So you're really identifying the inefficiencies in the profit and loss on the management side and working there versus necessarily trying to raise rents. So you're really like spotting, just like when people buy failed corporations and they go in there and fix the processes, the systems, and the finances, and automatically add value that way.
Correct, 100%. But it's also, there's different strategies for different niches, right? So myself, I operate in the affordable housing space. We're dealing with a lot of governments. Even through COVID, our properties have been fairly consistent. We didn't have a dip in rents. However, the flip side of that is if you go to a lot of these Class A or Class B properties, there's been a dip in rent. Why? Because people lose their job, people are not working, they can't afford the high rent, so income goes down. The owners could potentially get in financial trouble. Those Class A properties, now they're in trouble. They're not doing the maintenance. Those Class A, now they turn into Class B, and now they want to sell, right? And then that's how you get in trouble. So for me personally, I just found a niche. Now I do have other apartment buildings that I charge market rate on, and yes, I'm gonna, if I have a certain turnover, I'm gonna charge, the maximum that the market will allow. But I tend to those properties are in different areas, and I just see it as what everyone else is doing, just to kind of keep up, and there's nothing wrong with leaving some equity in the property as well. I firmly believe that you shouldn't be running to sell all the time. I try to treat the real estate as literally a cash cow. I just want to be paid. I don't want to go out, and now if I'm looking to do another deal, I'll pull equity out and leverage up. I'll do every 5 years or so. We'll definitely pull money out of the property, but the most important thing is cash flow. Every single month, cash flow.
What's the number one way that you guys are finding your deals? Are you finding these deals off market, on market? Are you marketing for them? And now I know you're developing now too. So before you started developing, what was the main way that you're looking at, finding deals?
Strictly, we get a lot of deals through wholesalers, right? So wholesalers hit me all the time. I was doing some direct marketing because when you go into a city, there's only a handful of apartment complexes, 50 units and up, and that's my focus, right? I look for 50 units and up. So let's say there's 6 or 7 of them in a whole city, right? Develop relationships with the owners, reach out to the owners, make sure that you're top of the mind. That's what I did, right? I made sure that, look, if you want to sell, make sure you call me and just be top of the mind. That's how I found a lot of deals, but then others, a wholesaler would come in. Another strategy that I use is I acquired, and this is a strategy that most people don't utilize, right? But I acquired property from the municipalities, right? Now,
like land banks, stuff like that.
Yes. Now, why is that such a secret? Well, number one, before they even get to the land bank, they're usually in trouble with their taxes, right? If you can find properties that are there, you can kind of circumvent the whole crowd, because if you can position yourself, and I've done this, position myself to buy the lien before it even comes up, and as the lien, if they're in trouble with the taxes, you're in a first position, right? So as first position, you can knock out a big mortgage. If not, they'll have to pay you an exorbitant interest rate, like 18%. So that was a strategy that I did a lot, and I was able to acquire some units like that. What I found is that if you use that strategy in the hood, and when I say the hood, I use that term, inner cities that a lot of foreclosures exist. Banks don't want to come and pay your lien out, right, and pay you the 18%, because they're like, well, if we do that, we got to manage. And I don't want to manage.
Exactly. Yeah.
Right. So what happens is, they end up falling back, and you end up getting the property. And I've gotten properties that way as well.
Yeah, we talk about the banks a lot and how the banks don't want to own real estate. Right. I was selling real estate during the last foreclosure crisis. Kevin was doing mortgages. Banks don't want to own real estate. We just picked up a property or a 5-property package 2 months ago from a bank that just didn't want to deal with it anymore. Right. So we got it for dirt cheap because they would rather get rid of off their books than have to have the actual management of the property. So, banks in the neighborhood, inner city are definitely good ways to get some good deals.
Absolutely.
And now you transition right into sorry, Kevin, go ahead.
Nah, go ahead.
You kind of transition to more developing now, correct?
Yeah.
How did you get there? Because that's always the next step. We want to buy an apartment, right? We want to go develop our own apartment, right? So how did you get to that step?
Well, I realized that in order to keep growing and keep doubling, I had to do bigger deals. And one thing that I realized is if you're in like the inner city, the land is scarce. So I know up north in Jersey, you can't find like 2 acres to 3 or 2. You can't. If you're in Atlanta or something like that, they have those assemblances that you can put together. But I realized that I needed to get into the development side so that I can create my own market, because there's still a need for affordable housing. There's still that need that exists. So I have to build it. And if you reach out to the municipalities, they'll help you build it. So a lot of the deals that we do now, it's in partnership with the municipality. They may be able to give you a cash money sometimes, or a tax credit to build. Like $1 million tax credit is $1 million. Like it's so when you go and you say, well, look, what could the municipality do? And they say, well, we'll give you $1 million tax credit. You can convert that to $1 million just by, just putting that on your tax return.
Yeah.
Get that $1 million back, so it's there, right? So, and I just want to tell this one story real quick. I know it's a little divergent, but I need people to understand that the government itself, every single municipality has a budget. So it's important that, if you're really looking to grow and jump into real estate development, it's important that you tap into that, right? And your taxes is one way in which you have to do it, and the way that you structure your business is another way. And I mentioned Kanye West, right? So Kanye West, we know he's a billionaire now, but 5 years ago he was in financial trouble, right?
Yep.
He was on the brink of bankruptcy, and he literally went to an accountant that restructured his business. He got $38 million back from the government, right? $38 million back from the government. So the point is numbers, right? It's all about numbers, right? And those numbers affect your perception. So you need to pay close attention when you write that check to Uncle Sam. You need to pay close attention when you put your deals together and you go to the municipalities and you ask for things, right? Take the tax credit, take the abatements, take all of that. This is cash. This is money that you won't have to spend out. You won't have to raise. You can keep that for equity. It's very important that you leverage all of these things. The other thing too, is don't give away all your equity on your deals. Learn how to leverage the banks. Learn how to leverage your business credit. Learn how to truly build wealth.
That's awesome. We have to have another show, Kevin. He comes on and gives us some tax strategies, because that's one thing that we both talk about a lot. I know you have a lot of different tax strategies just from hearing you talk before that you can kind of give us some help on, but that'll be a whole different show.
Absolutely. Yeah. Well, you know that CPA has earned me a lot of money.
I mean, that's the key to generational wealth, is not paying Uncle Sam more than you have to in taxes, right? I mean, that's the one part that people miss, is that tax strategy planning.
Absolutely right. So if you notice, the two ways to build generational wealth, one is through real estate, the other is through business. You really should have both, right? You really should be tapping into both. But if you look at the great fortunes that exist in this country, I mean, just look at what Amazon did. They made over $1 billion a year, didn't pay any in taxes. How is that possible? Well, there's laws in place. You have to leverage those and take advantage of it. So if you have LLC in particular, right? A lot of people were doing an LLC years and years before. But the key is when the new Trump tax laws, which were passed in 2018, the S corp became in vogue, right? So having an S corp allows you to get 20% tax credit, right? That's significant. 20% for companies, they don't have to pay 20% of their revenue or of their tax liability. That is just a major thing. And now, as we go into the next tax year, there's going to be other loopholes. So the key is to stay abreast of that, to stay knowledgeable about the ways in which your dollar is floating, and how could you get that back into your pocket so that you can invest and shut up.
Hey, promo. Hey, you've been talking a lot about affordable housing and then working with the local governments in the different areas that you're in. Is the reason why, because there's a lot of people that shy away from that they're scared to go to certain neighborhoods and certain cities and invest in and do things in. You are actually in there. That's what you're looking for. Aside from just the tax savings and the possible grants and all the benefits, what was the mindset and what else is it that attracts you to that affordable housing market?
Well, like I said, I grew up in affordable housing, so it's like I know the people, I know the struggle, and I know sometimes how difficult it could be, because what happens is you have these developers that come in and really they have no connection to the community, so they do exactly what we talked about earlier. The easiest thing to do when you come in is to try to raise the rent, because you're literally creating a $50 rental increase could easily bring you $1 million in valuation, right? The right size property. So the easiest thing to do is raise the rent and keep pushing the rent. But you have to understand that $50 every single month is taking food out of families, right? If it's coming from that way, it's like, it's more that goes into that. So it's important that you understand that. I firmly believe that properties that are in areas like that can be cash cows, but you have to realize that there's a fine line, and there's certain risks that are associated with them. There's certain things that can kill your investment, your asset, right? Drugs, gangs, violence, things that cannot be tolerated, as an owner. You have to basically you have to go in and weed that out. Gangs, unfortunately, you may think it's not an issue, but it creates other problems. So one of the first apartment buildings that I purchased was in Newark, New Jersey. Had the FBI come in, kick the door in, damage stuff. The bottom line is, I lost for about a year. I lost money. So being of the hood, being able to spot these things, being able to look at a block before I invest and be like, why is everybody with Chicago Bull jerseys on? It's not a jersey. Why everybody, wearing Chicago Bull jersey? Whatever it is, you have to be able to see certain things before they develop. And it goes into just having the experience to look into it. So these are things that you really, when you're investing in the hood, you have to be really cognizant of. And I will say this: no matter where you're at, take a city like Newark, New Jersey, population 300,000, but it's only a handful of people that are really causing some problems, giving the whole city a bad name. As an investor, you have to understand that, because that's so key, right? You have to realize that it's only a small group of people giving this perception. So if you can go in there and handle your block and make sure that your block is safe, make sure that you're providing adequate housing, you're going to be in good shape. And that's how I've been able to go into different hoods and find great deals. I purchased in Newark, I've got a 4-family, right? 4-family apartment building, $20,000, right? That we just closed on the top of the year, right? The point is, it's a shell. It's a shell. But to me, it's free money. Like, when I see those opportunities, it's free money, right? Now, it's Newark. But the block, it's a great block. There's families on the block. Kids are playing on the block. Not a lot. It's no gangs. It's whatever it is. But the fact is, most people would shy away from that because it's inner city. But look, the tenants, the families that's going to live there, it's going to be the best place they've ever lived in. I guarantee you.
Yeah, no, that's so key. I mean, you got to know what streets in the city you go to, right? Because it's always contained to a few streets. The rest of the neighborhood is usually pretty good. I mean, I do a lot of stuff in the inner city too myself. Pretty much everything I do is in there. And it's all about knowing the neighborhood you're at and then taking a little bit of risk. But if you help people out, I think the key thing you said is you might be under rent $50 a little bit, right? So I try to keep my houses under the market rent by around $50. I have a little room, and they stay there because there's more room. They're not being stretched.
You can be selective with your tenants when you do that too, right? Yep. So people be like, oh, that's a nice apartment, and I can afford it. You can pick the best tenant.
Definitely.
Now, when partnering with the local government, and if I'm in, let's say, Harrisburg, and we're looking to do an affordable housing project, who should I actually approach? Like, what's the next step to see if there's grant money and if there's people that are going to help us during the permitting process and everything we got going on? What's the first steps?
Right. So the first step is, and I'm actually going through this right now with my class, because I do a class called Apartment Acquisition Academy. And our very first assignment in the course was to go down to your local municipality, go into the zoning office, and look at the master plan. Every city has one. It's a master plan. It's a projection of what the city needs for the next 5 years. The reason why this is key and the reason why this is significant is because if you know what the city wants and you can provide what the city wants, there's a lane for you not only to get a great relationship, but also if the city wants it bad enough, they're going to pay you to do it. And that's kind of like the strategies that we teach. Also,
that's big. Right?
That's a huge gem right there. So you said the master plan would be in the zoning department.
Yeah. So you go to the zoning. The title might change from municipality to municipality, but whoever does the zoning. We all need zonings. It comes really from the mayor. So when the mayors come into office, they usually either appoint or use the master plan that's already in place, but it's part of the planning of the administration, what they want or what they see as the future of that city.
And that's key. It's like when you have an investor who says, hey, I'm looking for a duplex over here, right? You then go find a duplex he wants. If you're looking to develop, you go see what the city wants. They're telling you what they want to make, right? You go find out what the city wants, and you go build that and bring it to them. So
right.
That's a great gem you just dropped right there.
AD, if someone wants to partner with you, they're listening to this, they're saying, I need that mentorship, I need access to capital, I want to go out there and be boots on the ground and find these deals, but I need to know what to do. How does it work? Tell us a little bit about your program and some of the unique value propositions that you bring to the table.
Sure. So probably my greatest value proposition is Money Avenue. And a lot of it's difficult, right? So I have to get on these platforms to tell people what Money Avenue does. So because a lot of people don't know what we do because we have so many different verticals. So if I may, we're wealth management. That is the space that we exist in. We're just a replica of a family office. The problem is in our community, most people don't know what a family office is. So it's hard to say we're just a replica of a family office. So let me explain what a family office is. A family office is literally a hodgepodge, a group of people that manage the wealth of high net worth individuals. So when they manage the wealth of people that may be worth $300, $400, $500 million. That's really what a family office does. There's usually a person that does just insurance products for them, right? They'll come in and they'll do just the banking products. Another person may just handle the vertical of tax strategy or tax planning, which is what I do, right? So, and a lot of these family offices have about 20 people. And in that 20 people, they'll have a lobbyist, right? You think, why would they need a lobbyist? Well, very simple. What we touched on earlier, the lobbyist actually influences our legislators, people in Washington. Yep. Every single year, that money goes in to influence legislation, and the wealth, follows the actions of the lobbyists. Same thing that I talked about before with the S Corp came from lobbying efforts of the family office that figured if Trump could put this in play, this is a way in which we can, create some additional wealth. The idea is if you don't know these things exist, you can't take advantage of them, right? So this is what we do at Money Avenue, the wealth management. We literally follow the principles of the family office, and we have a 6-step plan to create wealth for thousandaires. What's a thousandaire? A person that makes at least $100,000 a year, or has a business that has the capabilities to make $100,000 a year. It's a 6-step plan. The first step, right? It's called the skyscraper to generational wealth is the strategy. But what we do is the very first step is you have to be a thousandaire, right? Mm-hmm. You need to be making either $100,000 or have a business that makes over $100,000 because we show you the plan to scale that business and basically become a millionaire. That's why I'm seeing on our site, thousandaires to millionaires. That's literally the path that we take. Level 2, we touched on in this conversation as well. The idea at level 2 is to live the rent-free lifestyle. If you can house hack, if you can get the FHA loan, do a duplex, live in one side, rent out the other, that is the concept. Some people don't have multi-families and wherever they're at in the States, then you have to get maybe single family houses that could compensate you to make your lifestyle rent free, right? So you don't have to worry about paying rent. If you can do that, you're living better than 70% of Americans. The third step, and we talked as well about that, it's getting to the level where you can bring your personal credit to 720. You lock your personal credit and don't use it anymore. We live through our business. We set up these business structures. We tell you what state you need to incorporate in so that you can have the best, not only liability protection, but coupled with tax strategy, right? How could you make the most for your LLC? Getting your structures right. That's what we do at level 3. And then we show you how to completely in level 4 completely leverage that to go out and get $1 million in debt, right? $1 million in debt through your business the right way. The right way to get $1 million in debt, because a lot of businesses fail. So we want you to have lots of LLCs, like Donald Trump, right? Donald Trump has over 500 LLCs, right? You know that he's filed for bankruptcy 4 times, but never under his personal credit profile, because he understands the power of business credit. This is what the family office does. They show you how to safely, so you're not jeopardizing your family, safely leverage business credit, and credit as a whole. It's debt, right? And you cannot scale up. You can't really, it's no quicker way to be a multimillionaire than without taking on debt. There's over 500 of the biggest corporations in this country. Only 2 of them don't have debt, right? So the point is, you have to be on a relationship with that and do it safely. You do it through your business. So if you get in trouble, you can pivot and move on. Level 4, we said go out and create $1 million. Level 5, the debt that you created at level 4, the $1 million in debt turns into equity. Level 5 is the level at which you truly become a millionaire, but you're a millionaire on paper, because at that point you'll have $1 million in asset. And then in level 6, what we focus on is creating that true path of generational wealth. How are you going to pass that wealth on? Structure, trust, a number of different things. Everybody has their own path. There's no blanket statement to say, well, everybody goes the same way. So what we do is we use our customer service to work with you one-on-one to find out what's your best path. Now, that may entail, getting involved in business or getting involved in the real estate, but it will be one or the other. And that's what we do at Money Ave.
Nice. Yeah. If you follow the Money Ave principles, you can potentially raise the funds to be able to acquire an apartment building structured under trust and different LLCs to be able to be protected, have the tax advantages. You guys are really just kind of bringing somebody all the way through whatever their goal is, but making sure they're doing it, covering all their bases, dotting the I's and crossing the T's.
Yep, pretty much.
That's strong, because every person that's making moves needs somebody watching out, because it's so easy to get sued, to do things the wrong way, to get taxed. IRS can come knocking on your door, and all that hard work gets flipped upside down.
Down the road, absolutely, 100%. So, we have a lot of different verticals. So we're just working on our relationship, our banking relationship. So now through Money Ave, starting next month, you're going to be able to have deposits that are FDIC insured. We'll also have insurance products that we're offering as well. That took us a while to get online, but we've have all the compliance issues out of the way right now. So people will be able to get insurance products. We're going to have our own business credit card. So through our business program, if you come with us, you're going to be able to get a Money Avenue business credit card that is not tied to your personal credit profile. In addition to that, you can always get real estate loans, commercial, residential, business loans. We are a lending institution as well. So the full gamut, the full verticals, the full myriad of products through Money Ave to help you scale, to help you build. This is what we provide.
I mean, real quick, you guys are, it's an actual chartered bank, correct?
We're an actual bank, and we're a very fast growing company. We're ranked 199 out of the top 5,000 companies, fastest growing companies in this country. So we, very quickly, we've become a multi-million-dollar company. And what we're trying to do is go after predatory lenders, people that are charging high interest rates in the community. We have loans that you can get in as little as 3 hours, anywhere from $5,000 all the way up to $10,000. Low interest rates, 2 to 3%. Not predatory enough to keep us in business, but yet we can pass that on so that more of your dollars stay in your pockets.
Kudos, man. Kudos to that. We talk about be your own bank on here a lot. We talk about whole life insurance policies used as a bank. So see what you guys are doing. That's huge. That's awesome.
Thank you.
Very much so. If somebody wants to get in contact with you, somebody wants to know more, somebody wants to plug in, what's the best way to reach out?
Sure. The best way to reach out to me personally directly is right there on the screen, the A Donahue Baker at Twitter. Or if you want to do some business with Money Avenue, you can find us on the internet, moneyave.com. Other than that, I have a YouTube channel. I also have a private Facebook group. It's called Generational Wealth Builders. In that group, we actually got 20 students from that group that we're creating 20 new developers. Excited because some of the students, like we just started a class like a couple weeks ago, but some of them are already doing amazing things. I'm going to be bringing more information about those 20 students. And hopefully by the end of that course, those students will have some wins. One of them is actually doing some incredible development deals right now I'm excited about. Then I just got off the phone with a couple others that are working on doing some things out west and also down south. So, it's a good group.
I'll tell you what, AD, when that happens, we want you and the best person out of your tribe right now to come back on the show, and we'll do a show on the development side of things.
All right, let's get it in.
Hey, well, we appreciate you, man. We appreciate you coming on the show, reaching out to us. You definitely have a vision that matches what we're trying to do. So we want to keep bringing on like-minded people that are doing big things in the community. Like you said before, shut up and invest. Right? There's many ways to go out there and do it.
I love it.
But let's go.
I love it. I'm going to ask you guys a question. How did the name Shut Up and Invest? How did that come? Because I love it. I was like, yo, Shut Up and Invest. I just like that. It's short.
I came up with the name Shut Up and Invest actually because me and Kevin met like 2 years ago at a We Live event. Right? We didn't even know each other. We both didn't even know each other. I had the name in my head already. I think I was just watching something. I saw Shut Up and Dribble. Right, like this shut up and dribble thing that they have with LeBron. You know how people always get stuck in paralysis by analysis. I'm like, yeah, just shut up and invest, right? So I had that name in my head, and then me and Kevin met and kind of put it together.
Awesome, good stuff, man. Well, look, fellas, I'm not gonna hold you up. I really appreciate the opportunity to come on your platform. I'm looking forward to returning, and we got to link up and do some things on the business end.
No doubt. I'm checking out moneyave.com as soon as we're out of this. Yep. I suggest you guys do the same. Trust me, every major business has a squad, has the CFO, has everything backing them up. So if you guys are serious, no matter how big your vision is, this is what you need to do. This is the way to do it right. So I appreciate you, man. This episode was fire. And you got it. That's it. We already made a deal. You got to come back on the development side.
For sure. All right, brothers. I appreciate y'all, man. Y'all have a good one.
All right, everybody.
All right.